Do you want to know how the RSI really works? Are you tired of getting false signals and missing big moves? And what if I told you that RSI divergences could completely change the way you trade? In this video, I'll break down everything you need to know about the Relative Strength Index RSI, not just the basics, but real, actionable strategies you can use to improve your trading. We'll cover how the RSI really works so you can finally use it the right way, why most traders use the RSI the wrong way, and how you can avoid those mistakes, what RSI divergences are, and how they can help you predict trend reversals, how to combine the RSI with other indicators for even stronger setups. And at the end, I'll show you my secret strategy that has made me a ton of money. All you need for this video is TradingView, and you can find the link in the video description below. Now open TradingView and click on Indicators at the top of the screen. In the search bar, type in RSI and click on it to add it to your chart. Then click Apply to confirm. Next, go to the Settings by clicking the gear icon next to the RSI indicator. In the settings, turn off the EMA of the RSI. Keep the length as it is for now. We'll adjust it later. Lastly, choose a color that you like for the RSI line and increase the thickness a little so that it's easier to see on your chart. The RSI, Relative Strength Index, is a technical indicator used to assess the strength or weakness of a market by analyzing the speed and magnitude of price changes. It ranges from 0 to 100 and is typically calculated over a 14-period time frame, though it can be adjusted based on specific needs. A high RSI suggests that the market has recently experienced significant upward movement, while a low RSI indicates a substantial decline. The RSI helps measure the market's momentum by comparing recent gains to recent losses. Surely you have noticed the two lines on the RSI. The higher one is the 70 line. When the RSI is above 70, it suggests that the market may have risen too quickly, which could signal an upcoming pullback or decline. On the other hand, the lower line is the 30 line. If the RSI is below 30, it indicates that the market has fallen significantly, potentially pointing to a possible rebound or reversal. But what do most people do wrong? The first mistake is using the RSI blindly. That means if the RSI is overbought, they sell immediately. But that's not good. We want to wait until we, for example, re-enter the normal range from the overbought zone. This indicates a potential reversal, because there is always the possibility that we enter the overbought or oversold area, in this case the oversold area, and the RSI never returns to the normal range, but instead the trend continues. Just because the RSI is oversold doesn't mean it can't drop even further. The second big mistake: traders do not combine the RSI correctly. Here we are briefly oversold and then quickly return to the normal range while forming an engulfing candle. But what does that mean? An engulfing candle completely surrounds the body of the previous candle, indicating that buyers are significantly stronger than sellers. This, combined with an oversold RSI, can generate very strong signals. The third big mistake is not looking at higher time frames. Just because the RSI is oversold on the 5-minute chart, it doesn't mean that it's also oversold on the 15-minute chart. Different time frames can show different trends and conditions. So focusing only on one time frame can give a misleading signal. By considering the higher time frame, you can get a clearer view of the overall market trend and avoid potential false signals. Here I'll show you what you should do better. In the 5-minute chart, we see that we form an engulfing candle and move from the overbought area back to the normal area, which is a bearish signal. Now we go to the confirmation of our signal on the higher time frame, in this case the 15-minute chart, and see that we have also formed an engulfing candle and moved from the overbought area back to the normal area. This is a strong confirmation, and we now have a good signal to start a sell trade. At this point, we could place our stop loss above the last swing high. A swing high refers to a point where the price reaches a local peak before reversing downward. It represents a key level of resistance that can act as a barrier for price movement. As for the risk to reward ratio, that's something everyone should assess for themselves. But in this case, I would recommend a risk to reward ratio of 4 to 1. This means we risk 1 unit to potentially gain 4 units. However, if a risk to reward ratio of 2 to 1 is reached, it's a good idea to move the stop loss to break even. Break even means setting your stop loss at the entry price, so if the market reverses, you won't lose any capital on the trade. Now I will explain divergences in the RSI. First of all, what is a divergence? A divergence occurs when the market moves in a different direction than the indicator. For example, the market makes lower lows while the RSI forms higher lows. What does this mean? This is a divergence. The indicator and the market are not in sync, they are moving in opposite directions. This can indicate that the current trend is losing strength and a possible reversal may be coming. Now that we understand what a divergence is, let's take a closer look at how we can use it in trading. When we see a bullish divergence, where the market makes lower lows but the RSI forms higher lows, it suggests that the selling pressure is decreasing. This means we could be looking at a potential trend reversal to the upside. However, we don't just enter a trade blindly. We need confirmation. So what do we do next? We check for additional signals. Are we at a strong support level? Do we see bullish candlestick patterns like an engulfing candle? If these factors align, then we have a much stronger setup for a buy trade. And as you can see, we have a support level here and we are forming an engulfing pattern. This gives us strong confirmation for a potential buy trade. We can now position our stop just below the last swing low to protect ourselves in case the market moves against us. Regarding the risk to reward ratio, it's important to choose what works best for your strategy. In this case, I would aim for a reward of 3 times the risk. If the price reaches a 2-to-1 ratio, I would move the stop to break even, securing the trade with no risk. All right, now comes the exciting part, the strategy that has made me tons of profit. I've kept it secret for a long time, but today I'm sharing it with you. Step 1, set the RSI length to 9. Why? Because it identifies overbought and oversold areas much faster than the standard 14 length RSI. This gives us earlier entry signals. Step 2, we need a trend confirmation. For that, I use the 200 EMA. Simple rule, if the price is above the EMA, we only look for long trades. Now let's put it all together. When the RSI is oversold and the price is above the 200 EMA, we have a potential long opportunity. Now, the opposite. When the RSI is overbought and the price is below the 200 EMA, we sell. But here's the game changer. You can take this to the next level by combining it with engulfing candles and support resistance to further increase your win rate. Look for a bullish engulfing candle at support when the RSI is oversold and the price is above the EMA. No matter what risk to reward ratio you use, this will make you incredible profits. Now, for the bearish side, we want to see a bearish engulfing candle at a strong resistance while the RSI is overbought and the price is below the EMA. This combination will lead to some big gains in your account. Try it out and let me know in the comments how it works for you. If you want to see more secret strategies like this, hit that like button and subscribe to the channel. See you in the next video. Let's go.